All right, class, welcome. So, imagine this. You get paid for a big project before you've even started the work. It feels pretty great, right? Your bank account is looking healthy. But here's the question we as business professionals have to ask. Have you actually earned that money yet? Well, in the world of accounting, the answer is a very clear no. And understanding that no is absolutely critical. Today, we're going to do a deep dive into a concept that really gets to the heart of this: unearned revenue. So here's our game plan for today. We're going to start with a classic business problem, one you'll almost certainly run into. From there, we'll nail down the formal definition of unearned revenue. Then we'll get into the nuts and bolts, the actual accounting entries. And this is the most important part. We'll see how this single concept can make or break a manager's decisions. And to wrap up, we'll look at a major pitfall, so you know exactly what to avoid out there in the real world. Okay, let's get practical. The best way to really understand an accounting rule isn't just to memorize it from a textbook, it's to see it play out. So let's kick things off with a very, very common scenario, one that's at the core of so many modern businesses, especially in tech. Now, I want you to stop and really think about this for a second. Your company's bank account just went up by $12,000. The cash is there, you can see it, but look at that word I've emphasized: earn. See, in business, receiving cash and earning revenue are two totally different events. Your gut, your intuition might be screaming, "We made $12,000." But this is where a fundamental principle called accrual accounting steps in. It tells us we can only recognize revenue when we've actually earned it by providing a service, not just when the cash lands in our account. And that distinction leads to a much more accurate and much different answer. Okay, here are the specifics. Let's say you run a software as a service company. A SaaS business. On the very first day of the year, January 1st, a new client signs up and pays you $12,000 upfront for a full year of access to your software. Now, the money is in your bank, no doubt about it. But think, on that very first day, what have you actually delivered to the customer? You haven't given them a year's worth of service yet. What you've given them is a promise to provide that service for the next 365 days. And in accounting, that promise is everything. And this exact situation, this gap between getting paid and doing the work, is precisely why the concept of unearned revenue exists. It's a rule that makes sure a company's financial reports tell the true story of the business, not just the story of its bank account. So let's get that formal definition on the table. You see, the trigger for recognizing revenue isn't cash, it's delivery. It's fulfilling your obligation. Did you deliver the product? Did you provide the service? For our software company, that service isn't delivered in one lump sum on January 1st. No way. It's delivered a little bit every single day for a full year. And that means we have to recognize the revenue in the exact same slow, steady way. This right here is the single most important mental shift you have to make today. That $12,000 that just landed in your bank account, it is not revenue. From an accounting standpoint, it is a liability. I want you to think of it just like a debt. Now, it's not a debt you're going to repay with cash. It's a debt you're going to repay by providing a service over the next 12 months. You owe your client 1 year of software access. And this chart illustrates that difference perfectly. Remember our fundamental accounting equation: assets equals liabilities plus equity. When you actually earn revenue, that increases your company's equity, right? It makes the owner's stake in the company bigger. But in this case, that upfront cash payment doesn't touch equity at all. Instead, what happens is we increase an asset, cash, and at the same time, we increase a liability, unearned revenue. The equation stays perfectly balanced, but it's telling a story of obligation, not a story of immediate profit. So, now that we've got the theory down, let's roll up our sleeves and get into the mechanics. How do we actually translate this business event into the formal language of accounting? I'm talking about journal entries, debits, and credits. It's a really logical, step-by-step process that happens over time. First, you record the cash coming in the door and the new liability you have. Then, and this is the part that keeps your books accurate, at the end of each accounting period, say every month, you have to make what's called an adjusting entry. This is where you update your books to say, hey, a month has passed, we delivered some of that service, and that finally allows you to recognize a piece of that money as revenue you've actually earned. So let's look at day one. January 1st, the moment the payment comes in. This is the journal entry you make. You debit cash for $12,000. Why debit? Well, cash is an asset, and we always increase assets with a debit. Simple enough. At the exact same time, you credit unearned revenue for $12,000.
Why a credit? Because unearned revenue is a liability account, and we increase liabilities with a credit. See how it works? Debits equal credits. Our balance sheet now shows we have more cash, but it also shows we have a new obligation.
Okay, now let's hit the fast forward button. 1 month has gone by. It is now January 31st. We have provided 1 month of our 12-month service contract. We have therefore fulfilled 1/12 of our obligation to our client. The math is pretty straightforward. $12,000 divided by 12 months tells us that we have now, finally, truly earned $1,000 of that initial payment. And this is our critical adjusting entry at the end of the month. To show that we've paid off part of our debt, our service debt, we need to decrease that unearned revenue liability. Now, since we increase liabilities with a credit, it follows that we decrease them with a debit. So we debit unearned revenue for $1,000. And at the same time, we can finally recognize that income. So we credit a revenue account. Let's call it service revenue for $1,000. Revenue accounts are increased with a credit. And this $1,000 is what will actually show up on our income statement for the month of January. And guess what? We will repeat this exact same entry every single month for the rest of the year.
So you might be thinking, okay, I get the debits and credits, but why do we go through all this trouble? What's the so what for a manager or a CEO? Well, this is where accounting stops being about just bookkeeping and becomes an incredibly powerful tool for making smart, strategic decisions. By handling unearned revenue the right way, we create financial statements that tell the truth. At the end of January, our balance sheet doesn't just show our assets. It honestly reports that we still have an $11,000 liability. We still owe 11 months of service. And our income statement? It gives a true, realistic picture of our performance for January, showing only the $1,000 we actually earned. This perfectly follows a critical rule in accounting called the matching principle, which insists that we match revenues to the specific period in which we earned them.
Okay, let's really put ourselves in the manager's shoes. It's the end of January. I look at my bank account and I see a nice big cash balance from that $12,000 payment. I might be tempted to think, wow, what a fantastic month. The business is crushing it. Let's go hire that expensive new engineer we wanted. Let's sign the lease on a bigger office. But then my accountant hands me the income statement, and it reports just $1,000 in revenue. That is a massive reality check. It forces me to be disciplined. It reminds me that I have to manage this cash very carefully because I still have to pay my employees and keep the lights on for the next 11 months to earn the rest of that money. This is how you make decisions based on the economic reality of your business, not the happy illusion of a full bank account. Honestly, this is what keeps a young company alive.
And that leads us straight into the most common and the most dangerous mistake that I see students and even new entrepreneurs make with this concept. Let's look at the 2 paths you can take and visualize the very real consequences of getting this wrong. Just look at these 2 versions of an income statement for January. On the left, we have the wrong way, booking the entire $12,000 as soon as the cash hits. It paints a picture of incredible but totally fictional profitability. Then on the right, you see the correct, the ethical, and the sustainable picture of the business, reflecting the actual performance for the month. So let me ask you, which company would you rather invest your money in? The one that's built on a foundation of reality, or the one that's built on an illusion? The answer's pretty obvious.
The consequences here are enormous. First, you are fundamentally distorting your company's performance. This misleads anyone who relies on those numbers. Investors looking to buy stock, bankers deciding whether to give you a loan, you name it. It also leads to terrible internal decisions, like paying out big bonuses based on these phantom profits. You're literally spending cash you haven't truly earned yet. And at the end of the day, you are violating generally accepted accounting principles, or GAAP. Think of GAAP as the essential rules of the road for accounting in the United States, and breaking those rules can have very serious legal and ethical consequences.
So I'm going to leave you with this final thought exercise to chew on. Different industry, much bigger number, but the exact same principle applies. A concert venue sells $1 million in season tickets back in March, but the concert season doesn't even start until June, and it runs through September. So when is that revenue actually earned? Answering that question correctly, using the principles we've covered today, is a huge step in your journey to not just reading financial statements, but truly, deeply understanding the story they tell. It is a key step in learning to speak the language of business.